I worked under the assumption that I was going to be working in the workforce until I was 65. And to be honest, that is what I saw modeled for me. My mom is now 60 and she still works 3 jobs. She loves them, by the way. And my dad is 62 and he's been working at the same company since he was 16 years old. So you can imagine how that seemed 100% normal to me, working to 65, working hard for my money. And with the average life expectancy now being 76.1 years, if I worked until I was 65, I'd have a little over 11 years to enjoy my retirement, assuming that my health was still intact. Now, obviously, that's not the route that we took, and in today's video, I'm going to share with you the origin story of my financial independence with Purpose Planner, and this planner helps you answer 3 very important questions. How much do I need to invest to achieve independence? How long do I need to invest to achieve independence? And can I achieve independence or FIRE early? Because I tell you, when I did this work for myself and I could actually answer for myself how much more hustle and how much more grind will be enough, I couldn't wait to start taking action with my hard-earned money. As a matter of fact, this planner helped Joseph and I get really clear on how we were going to pay off $420,000 in debt. We invested over 60% of our income many years. We became debt-free millionaires at the age of 37, and I became a lot more comfortable and found a lot of peace leaving my multi-6-figure job in tech to work on something way more aligned to my values, which is helping women pursue financial independence through investing. So go download the planner below in the description if you want to go ahead and take notes and start taking action. And if you're new here today, welcome to the Permission to Be Wealthy channel. My name is Stephanie, and my husband Joseph and I have open and honest conversations about what it's like to build wealth, to invest, and to pursue financial independence. We are now a debt-free millionaire family of 4, living in Portugal and designing our life on our terms. And if you're finding value in today's video, go ahead and like and hit the subscribe button so you can join us weekly as we share our experience. So while I pull up this planner, you're probably noticing that this is a custom-built sheet, and you may be asking yourself this question: how in the world did Stephanie pull this together, and what experience does she have? I'll try to make this short, but I spent over 11 years at one of the top 3 global technology companies, and while I was originally personally responsible for planning and forecasting piece parts for notebooks, desktops, and monitors, I eventually moved into a position of global director of the supply chain, where I was based in Singapore, and I was responsible for pulling together GMs, general managers, presidents, and VPs all across the company to make decisions based off of forecasts on how we were going to achieve our billion-dollar plans as a company. And so as we started pursuing financial independence and I was looking at how we were going to put together our plan, I thought to myself, if I can put together a billion-dollar plan for people to make decisions off of and take action off of at a company, I know I can build $1 million and multi-million-dollar plans, not only for myself personally, but to help other women do the same. So in 2021, my Financial Independence with Purpose Planner was born. It has been downloaded and taught over 320 times, and that's going to be the focus of today's video. So first, we're going to talk at a high level about the 3 functions that go into determining when you can ultimately retire. That's your income, that's your spending, and your savings rate. And when you look at these 3 pieces of information, you may be telling yourself, well, if I make $70,000 and I spend $50,000, I have $20,000 left, and that's it. That's what I save and invest. And while that might be true, those that are pursuing financial independence retire early are looking at these numbers through a fine-tooth comb. They're getting really purposeful. They're getting really intentional with what these numbers tell them and what action they ultimately need to take to not only achieve their plans, but to potentially accelerate their timeline towards their goals. Because we need to start being honest with ourselves. It is not uncommon that I speak to someone and they tell me, well, I was originally just thinking that my retirement was going to work itself out. And the reality is that for someone who is 55 to 64 years old, the median retirement savings for those individuals is $195,730. So that means if you withdraw 4% of that overall investment, you're going to be able to pay yourself $652 a month. If you need at least 11 years in retirement, that can be pretty rough. So let's look at our spending first. And what you spend has 2 different impacts on your path towards retirement: what you spend now and what you spend in the future. So in terms of what you spend now, the average 40-year-old American makes about $63,000 a year. And if that individual spends $45,000 annually, that means that they can save at a rate of 19%, aka your savings rate. And the higher your savings rate, the statistically faster you will be able to achieve your your financial independence goals, which means your investment should now be able to cover your living expenses in retirement to a certain period of time. And that also assumes that you're spending at the same rate that you're spending today. But let's take this another step further. What if you plan to spend something different in retirement? Another way that you can look at this is by calculating your FIRE number. So let's make an assumption. If we spend $3,500 a month in retirement, that means that we're going to spend about $42,000 annually. And if you multiply that number by 25, then you need about $1,050,000 in retirement in order for you to withdraw 4% from that overall investment and have that investment last in your retirement years. So now that you can see how spending and savings play into the overall equation, let's now go to my financial independence planner so that we can start taking a look at the specific details that you need to understand, also including your income, because I didn't forget about that part. We're definitely going to talk about that throughout the video. So whenever you pull up the planner, you're going to notice that there's two main sections that you'll ultimately take a look at when all the data is put in. A visual representation at the top and a data version at the bottom that summarizes the answer to the magic question: at what point do my investments equal or exceed the amount that I have to have invested in order to support my living expenses in retirement? So as we plug in our information, let's ground ourselves in a few pieces of information for this specific scenario. We're going to use an income of $63,908, which is based on the U.S. Bureau of Labor Statistics data for a full-time wage and salary worker age 35 to 40. So we're looking for someone in their 40s specifically for this scenario. We're assuming that this person has an employer that offers a 401k, gives them a 6% match, and this individual is investing up to that match. They pay about $8,268 in taxes based on their income, and the $3,800 that they're going to be investing into their 401k being tax deductible. And they spend about $3,750 monthly and plan to spend $3,500 in retirement. All right, so as I plug in these pieces of information for this specific scenario, I'm going to guide you to how to actually plug in your information as well. So first, go get a 401k statement, and if you have one, plug in how much you're investing into your 401k each month. If you don't have this account, that's okay. Just put 0 into this specific cell at this point in time and check to see if your employer has a 401k or if you're interested in an employer that has a 401k in the future. That can be something that you take a look for in terms of benefits. You then want to go to the next section here, which is your after-tax income, i.e. your net income, which is what you see hit your bank account each month. Put in the monthly number there. And now we talked about how important your spending is in this equation. So you now want to plug in how much you spend monthly. Now, if this is the first time that you're doing this and you need more data in terms of a trend to understand what your numbers really are, I suggest going to get about 3 months worth of history, bank statements, credit card statements, income slips and statements, all of that stuff, and then take an average of what those past 3 months of history look like and what they actually say to you. Start there, and then you can start fine-tuning your numbers and having a deeper relationship with those numbers along the way. And now you've gotten to this point in the financial independence planner that's going to calculate two specific things for you: your gap, which is your income minus your spending, and your savings and investing potential, which adds your gap number plus your 401k contributions that you're contributing monthly, because you don't want to forget about those. Those actually play into your overall savings and investing equation. So now we talked about how spending in retirement, right? This second level of spending is important in helping calculate your retirement goals overall and your FIRE number. So we're going to get your assumed monthly living expenses in retirement and put them over here in this cell. And now you can see that your FIRE number is calculated for you. You're only adjusting things that are in yellow in this sheet. Anything that's in blue is going to have an automatic calculation, okay? And this FIRE number is going to port into two specific sections: a visual representation up at the top, so this line, and then it's also going to port into the analysis down here below with all the data so that we can take a look at when our investments achieve or exceed the 4% withdrawal limit, and there's some color coding to help distinguish that for you. So next, if you have some other existing investments, you want to summarize that number here. This is going to serve as a starting point to the compound interest calculation below here. And below is where we're going to actually start projecting our financial independence plan. First, you want to personalize this for yourself. So go add your age and the current year in here because we used an average income for someone that was 35 to 44 in the initial assumption. So I'm going to put 40 in here in 2024. Then be sure to take note of the standard assumption in the sheet, which is included in the growth of your investment section, right? Which this is in this table, this says 6%. We have a 6% rate of return, and there's a low and a high scenario in this analysis. And whenever I look at projections and financial projections forecasts, I always think of not only the happy path, but a range of low and high possibility, because that gives you a sense of what to contingency plan for, okay? So if you put 6% in the middle, you're going to get a 4% and an 8% rate of return calculated in the compound interest calculations below, respectively, in the columns to the left and to the right. If you adjust the middle number to something like 8, then your left number is going to be 6, 8 minus 2, or 8 plus 2, and 10% in the column to the right. So just make sure that you understand if you want to change that number, why you want to change that number. Are your investments actually aligned to giving you that rate of return? Because we can put whatever numbers we want in this spreadsheet, but we need to be realistic about what we're expecting. And so now we get to the part where the planner helps you have an open and honest conversation with yourself about what actions you take now get you in terms of the goals towards retirement. So if you have a starting point of $887 a month as your investing potential, you commit to investing that monthly amount for the next 15 years. You plan on your investments delivering you a rate of return, so an annual compound interest of growth of 6% annually. You don't make your financial independence number here in this example until you're age 72. And I want you to read this disclaimer because this is important. Remember, I'm not a financial advisor, and projecting your financial plan is just that, a projection or a hypothesis. And this is based off multiple variables and assumptions, right? You should use this as a point of view and something that you take full responsibility for and how you follow up and take action, and for the research that you need to do while taking on the inherent risk associated with investing in equities, okay? It's really important that we understand that whenever we enter the realm of forecasting possibilities, right? So now if I saw this, I'd be asking myself, well, what do I need to do in order to achieve my financial independence plan and make it a reality for myself? Whether it's I'm okay with what this tells me, or I feel like I need to catch up, or I want this to look different for the life that I ultimately want to live. And there could be a series of things ranging from increasing your income, doing a deeper dive on your spending and understanding is that aligned to your values, or even checking to see if your investments are actually helping you achieve your goals and delivering for you a rate of return or the rate of risk tolerance that you expect in your overall portfolio to make you feel comfortable. Some of the questions that you can ask yourself, and I'm going to list them here below, is do you want to go for a promotion? Do you want to change companies to potentially make more money? Do you want to side hustle? Start that so that you can increase your income along the way. Do you want to pay off your debt at a more accelerated rate so you can free up some more investing dollars along the way? Do you want to move to another location and potentially reduce your living expenses? And in general, are you spending and making income aligned to your values? Because life is short. While we do want to achieve financial independence, of course, and potentially achieve that early, we also have to think about our current life in the now and in the present. And that's the point of this financial independence planner. No more hoping that you can pursue financial independence and doing it blind. You sit down with your numbers, you have an honest discussion with yourself on where you are. You truly think through, and I really want you to take this seriously, you truly think through the action plans and the commitments that you need to make yourself to make this plan a reality, and you start taking action. So now in this next round scenario, Susanna is who I'm going to name this individual. She looks at her skills, she looks at her marketability, and she looks at what she wants to ultimately do with her work, and she decides that over the next 10 to 15 years, she's going to make a plan. And with that plan, she's going to go for job promotions and potentially move companies, requesting at least a minimum of 20% an increase in her income because she can market her skills to show her value and her worth to get that income. And she's planning on making that move at around the age of 41 the first time and age 46 the second time. Again, this is a scenario. She can accelerate that. She can make changes to what she ultimately asks for. I recommend that she asks for more if she needs to and she thinks that she should. But over the next 15 years, she does that. And she also knows that because of the domain of experience that she has, specifically in advertising, she takes up a side hustle, a consultancy, and she offers her services expecting that she's going to make about $1,000 of additional income per month. She also knows that she's going to pay off her home at the age of 45, and so that's going to free up another $800 a month. And now, assuming that she's invested in equities, stocks, index funds that deliver a 6% rate of return, she can now meet her financial independence retire early number by the age of 54. So she moved that timeline from 72 to 54. Now she has some clarity. Now she has some motivation. Now she has some skin in the game, and it is up to her to take some action. Now, I understand that this is just a scenario and your scenario could look very different, but I will tell you that as individuals fill this out and really have a wholehearted conversation with themselves, not only do they get more excited and motivated about their ability to pursue financial independence, no matter the timeline, but as changes happen in their financial situation, they're more confident in being able to plug in their numbers of those changes and understand what that means to them more in real time. I hope you found this planner helpful and definitely more useful than the compoundinterestcalculator.gov online calculator that's out there, because you can put more of a personalized view of what you want to see, not only at a high level, but each year in terms of the action that you want to take. I'm going to be honest, this exercise really helped me understand some of the infinite possibilities that were out there for me to be spending my time. And I hope today's video gave you just a little bit more food for thought and an actual tool to give yourself permission to be wealthy.